G'day traders, how are you? Here we are. We've got Fred and myself together at what we call Control Central. Well, I like to call it Control Central, but Fred might call his place Control Central. But anyway, here we are at Control Central. And what we're going to discuss today is how we use a visual method to test for an edge on our trend following systems. The method itself has been derived from a process that was found on Tim McMaster, an interview with Tim McMasters, who worked closely with David Aronson. Tim is an expert statistician, and there was a great podcast on Better Systems Trader, which we'll put up on the screen, which gave a chance for Tim to weave his magic, where he explained how he uses a process of randomizing market data as a basis to assess whether a system has an edge on out of sample data or not. So Fred and I, we were very rapt with this process that he described, and we've decided to apply it ourselves. And Fred is a genius. He's done the programming behind this process. But in this particular video, we're going to give you an overview of what we're seeking to achieve, and then give you a full demonstration of the process at the end of this video. So, how are you, Fred?
Yeah, good, mate. Thanks for letting me make a little bit of noise on this video. So what we wanted to try and do is take what Tim put it out in his podcast and see if we could apply it in our world, which is MT4. And so we've created a way to take the market data. We like daily bars, so we've taken the daily bar stream of any equity curve, any price curve that we're looking for, and managed to shuffle the things around, as Tim explains, to create a equity. I keep calling it equity, sorry mate, but it is market data, not equity. So it's price data, and a way to create price data that is using components of the real market, but putting it together in a different fashion to randomise that effect. And I think you'll see to some extent before we're finished that the market has an edge, and by creating randomised versions of that market data, that edge goes away.
Yeah, look, this is very important because as a trend traders, in developing these systems, over the course of time where we get very attached to our systems, we start thinking in our minds that it's our system that's developing the edge, but it's actually not. We are relying on the edge that exists in the market data, so we're looking for trends within the market data itself, and then our systems themselves are the methods that we extract that edge from that market data by capturing that trending condition. So our systems are not what is the trend, or is not what defines the trend. There is this market trend, and our systems are the means to capture aspects of that trend. And you'll see that in play through this process.
Yep. So, do you want to go and show how we created the data first, or do you want to move into something else?
I think start with an explanation of how you randomise that real market data.
Okay, well we'll pause the video here and we'll flick across to an explanation.
Great.
Yeah, hi folks. We're just going to talk about how we've created this randomizer. There'll be other sections that cover it in detail, but I just wanted to explain the process we went through to come up with the random data series. So if you look at any data stream, there'll be bars, and we're looking at a range of the bars from 10 years ago till the current day. So we're capturing bar information as we go through. We're getting the high, the open, the close, and the low of every bar. And what we then do is we look at the relationship between the close of bar 1 to the open of bar 0. So it's the relationship between these two price gaps here, and we capture that as a percentage change against the closing price. We then look at the open to close relationship of the current bar, and we measure that as a percentage of the open price as well. We then look at the size of the upper wick and the size of the lower wick in relation to that bar structure. Once we've gathered all that information, we then put it into an array, and then we randomise each point along the array individually. So we create a new random series based on the closing price. So if we pass through from start to finish, we have a starting price. We then add an opening price based on a random selection out of our array of a previous gap. That then gives us the starting point for the creation of this new bar, and this new bar then is formed as a relationship between previous bars. So this bar existed sometime in the past. It had a high wick and a low wick and an open and closed gap. We've then taken that information, randomised it across the data stream, and in that way we've been able to create a new data stream in a random fashion. It's not random per se, but it is random based on information collected from existing bars. Hopefully that explains it in some detail.
Well, thanks for that, Fred. That shows us how you've gone about randomising the data. So let's now have a look at some real market data, and then we'll apply the randomiser to generate random market data and see the impacts of the real market data and the random market data when we apply a standard trend following system to each of those data sources.
Okay, let's do that, and maybe I'll explain a little bit about how we're generating the trader. But in the meantime, why don't you bring up a standard chart so people can see what we're talking about?
Okay, so I'll bring up a chart of Euro USD on the daily time frame, and I'll just move this down a bit. I'll take these off, and we'll just scroll through this data to have a look at the nature of that market data. We can see some clear, good trending periods here. There are lots of different trending periods throughout this real market data. And so as a trend follower, that's what we're trying to extract, some of that edge that exists in that data. So that's the real market data. Let's now have a look at one of your algorithms. Fred, I'll bring over these settings and you can explain it.
Yeah, so what we've got here, we've created a trader that basically looks at this CSV file and takes its input from this CSV file. So what you can see here, the interesting components of this, it's a Donchian breakout trader, so it's going to look at different look-back periods, and you can see here we're ranging from 200 in steps of 50, from 200 through to 1,000. So there's effectively 17 traders there, each of them with different Donchian periods, and being a trend follower, we're looking at short stop losses and letting the trails run. So we've got a stop loss in here. It ranges from 1.25 ATR through to 5 and a bit ATR. So that sets the initial stop loss. The position size is based on the risk against that stop loss. So we've got common risk across the board. So effectively on a shorter stop loss, we're having a larger lot size, and a larger stop loss will give us a smaller lot size. And then we've just, for convenience, copied that stop loss across to the trailing stop loss, so it'll trail in the same vein in terms of multiple of ATR. So this is straight off the bat a pretty basic trend following system using a Donchian with various settings.
Thanks, Fred. Okay, so what we're going to do now is we're going to run this particular trend following trader called ATS trader with this particular specification. We're going to run what Fred has just described over the real market data and see how it performs. So I'll just turn it on visual mode here. So, okay, so we're applying 0.1% trade risk based on our closed equity balance for all of these algorithms. That ensures that we've got a standardized treatment and we're ready to hit the go button. So I'm going to start it off now.
This is running from 1976, so it's starting a long time ago. We've got a lot of data there, and you can see there's periods of, maybe expand that just a little bit, Rich, to give us a chance to see the trends when they do form. And you can see the trader coming in. There's multiple trades there with multiple trailing stops, and for each red line, that's the stop loss setting. And you can see the trailing stop moving as price moves the trails come up behind it. We've got various donkey and period lookbacks, so some will come in quicker than others. And you'll see, here we go. And so what you can see there is we're building some equity as the graph shows, and you can see those trades moving through. Typical trend following fashion. We're picking up trends that last for a fairly long time, and we're trailing behind.
That's great, Fred. So what we might do, so that people now can visualise what's happening and they can see how this is trading in accordance with the trends in the market data and capturing segments of those trends. So we'll fast track now to the end of the process, and then we might try this on another market.
Yeah, great idea.
So here we are, we're at 2014, or we're catching a beautiful short trend here. I feel like a racing announcer. And notice that the equity curve spikes up when we catch these beautiful outlier periods. But the equity curve has had a very good performance over the course of the history. There's lots of periods of stagnation and slow building drawdowns, but significant points where...
That's fairly indicative of trend trading. There are going to be periods where nothing much happens. And so if you're trying to work out where you sit in the market, you don't really know until it's passed.
Yeah, that's why to determine an edge from these systems, we need to use the entire back test as a method to assess its performance potential. But there we go. So that's the end of the test, right up to current day. We've got a very nice equity curve that started down at 100,000 start, and let's go to the report quickly. We see that we've got a profit factor of 1.66.
Over 1,000 trades.
Over 1,000 trades. A low drawdown of 9.9%, and this is just for that market, Euro USD.
And that's off the back of a pretty standard, simple donkey and break trading system.
Exactly. So look, just to convince people that you can apply these trend following systems across multi-markets, we're just going to apply this now to another market. Let's try AUD USD. And we're going to do the same exercise but in a speeded up format. So rather than show you the trades undertaken, we're just going to go to the equity curve itself. It should take a quicker period. Let's hit it. So we're using that exact same system we applied to Euro USD. Here we go, on real market data.
Just open the chart. Here we go. And it's exhibiting the same sort of pattern as we saw in the Euro. There's periods where it's flat, there's periods where it takes off. So it's indicative of picking up those outlying trades.
Yeah.
The fat tails.
This is very much in concordance with what Jerry Parker says, in that these trend following systems are applicable across any liquid market. We're just demonstrating it here by choosing at random another market, say AUD USD, and seeing how this trend following system applies.
And the reason we're doing this, Rich, is so that we can now randomise the data using what we've spoken about earlier to see how this same system performs across a random data set.
Yeah. So look, we'll now just see how much we've got. We haven't got long to go. We'll get to the end of this test. This is on the live market data for AUD USD, then we'll get into the random data. It's almost finished. A good equity curve over the course of time. Let's see what the statistics produce for this particular market using that same trend following system. Almost there. This is another 40-year back test. So here we go. The results, a profit factor of 2.24, so even better than Euro USD, and a lower drawdown, 8.33%.
Similar number of trades, over 1,000 trades. But 1,000 trades over 40 years, it's an infrequent trader, but it's trying to pick out those outliers.
Beautiful, mate. All right, so now that we've clearly demonstrated to you how these trend following algorithms perform on real market data, now what we do is we explain this method of randomisation. We've got a chart here. So Fred, can you explain this chart?
Yeah, this chart is, how many we got here? 14. We got 14 equity charts.
Or 14 random equity charts and one real
one. That really dark red one is the market data as it was seen for real?
For the real. This was on our Euro USD, the real market data. It produced this was the market data that the equity curve that was generated worked off.
Correct. So this is market data. This is not equity. And so the other charts on here are effectively our random charts, which we're going to show you in a moment. We explained how they were generated earlier, and you can see that they all start at about the same place and they all end at the same place, is what you'd expect because of the way the random data was generated, by plucking segments of the real data out and reshuffling them to come up with that answer.
And we've done that to break up the bias in the series, haven't we? To reshuffle and break
Well,
any autocorrelation.
we're trying to prove to ourselves and to everyone watching that that there is some inherent bias in the true market data.
Yeah.
And we're not seeing that same bias. So by looking at these equity curves, the novice would probably look at this and go, well, okay, if I can trade one, I should be able to trade all of them.
Yeah, if I saw that blue market data there for that random equity curve, I'd think that would have huge trending
impact.
potential, and I'd get a very good equity curve from that.
So let's go and have a look.
Let's have a look. So, when we apply the randomisation, the first thing we'll do is we'll have a look at the equity curves that result from the random market data. So here we have 14 equity curves that are generated from the 14, or in this case we've got 14 random market data series. The R before each of these series here means random.
We probably should demonstrate one of those, shouldn't we?
Yeah.
Let's grab one and chuck it into MT4 and see what happens.
So I'm now going to take my real market data and I'm going to delete that real market data. So all my real market data is gone. Now I'm going to import your randomly shuffled market data, Fred. So I'm just going to find where that is in my random series. And I'm going to take this one here, random 1. This is the first randomized series that was generated by your script, Fred.
Yep.
And I'm going to load that into my MetaTrader platform. So here we go. There it is. Now, if I look at that market data, I've just got to bring over a chart. Now, when we eyeball that market data, it looks like normal market data, doesn't it? What do you say, Fred?
Yeah, it's got characteristics of the euro for sure. Periods of trending, periods of stagnation.
Exactly. So you'd think that with a trend following system, we'd get a very good result out of this.
Well, considering we ran the same EA across the euro and the Aussie and ended up with profitable systems, you'd expect this one to be profitable also. There's some really good periods of trending in here.
All right. Well, let's put this to the test and run our same EA for Euro USD, now using this random market data. So let's run that test, Fred, and we'll visualize it for a bit and then see what's happening. So here we go. I'll slow this down a bit. So it's now working off the, this here is the random market data series, and you can see where the trades are being taken by the system. So it's still catching short trends and long trends in accordance with the system rules. However, none of them seem to be very long trends, do they?
Well, it's interesting that looking at it, you'd be hard pressed to tell the difference. I think it only becomes obvious when you start looking at the graph and seeing what's going on.
So here's our underlying equity curve as the trades are being undertaken. You can see it's a pretty sad story so far. It seems to be declining.
Let's speed it up a bit, Rich, and see if we can't. Yeah, there's some periods there where it looks like it's going to pick up.
Now there's an example. It certainly does capture trends in that random market data series, and we do get little lifts occasionally, but they're not sufficient to give us an edge, are they?
Well, it appears not. Let's give it a chance. So again, we might pause here, Rich, pause the video, but come back, not pause, but we'll pause it and come back towards the end because it might take a little while.
Okay. So, it's not going too well, is it, Fred?
Yeah, which is a bit disappointing, I suppose, but it probably highlights the fact that an EA that works on true market data doesn't work on random data. So what is that telling us?
Well, what that's saying is that we cannot get any, we can't make any inference about whether trends exist by visual methods alone. So we can't use a chart, a graphical chart like this, to discriminate between random market data or real market data, and therefore our ability to use it for technical price patterns or any method of technical form of analysis is a bit of a dodgy exercise. But what we can do is we can use quantitative methods, such as we do here, to identify this underlying bias in that data series through a workflow process that can therefore generate these profitable systems.
Do you want to bring that other graph back up, Mitch, the one that showed us the...
So clearly this one here is just to summarise on this one, this has been, we're almost down to total loss here. If we look at our performance, we've got a negative profit factor, big loss, big drawdown, 25%. That's off the random market data over the series. We wouldn't want to be trading this. When we look at all of the different random equity curves, you'll see that in the short term, some of them do very well. Some of them do very well here. And for a trader, for instance, our trades were over around about 1,000 trades, so over about a 200 trade history. Some traders who are fortunate enough to get an equity curve from the random market data that looked like this would think that they had an edge, wouldn't they?
Yeah, and it'd probably take them quite a while before they decided that wasn't working any longer.
Yeah.
So it's probably, you're in there for what, 200 odd trades. You're probably going to hang in for another 100 trades before you decide it's not working anymore.
And look at this for a trend follower. A trend follower would be in here from 1972 up to 1990 before they realised that they were trading a random.
Sorry, that's 1980, mate.
So yeah, so 1972 to 1980, 10 years before they realised that they had a dodgy system that was working off random market data.
So I'm really keen now to see what this looks like when we add ours back in.
All right, so here we go. So suddenly all of those random equity curves almost disappear to zero when compared to the equity curve arising from the real market data of Euro USD.
Well, if that doesn't show you that there is a trend in the market, you're missing the point.
Yeah, you're missing the point exactly. So this is really our only way for trend followers to visually determine if there is an edge in our trading system. We can't really...
Well, you say edge in the trading system, but I think our trading system is capitalising on the edge in the market
data. That is totally correct. So, guys, we hope you've enjoyed this this video. It certainly shakes up the mind a bit in relation to questioning what we're doing in this trading world and how we're trading and why are we using visual pattern recognition methods when clearly we realise that our brains can give us the wrong inferences, don't they?
Yeah, this randomiser, I mean, while we've applied it into our world, which is trend following, it'd be really interesting for someone who trades patterns, who trades mean reversion, etc., to try this randomiser on their own charts, their own EAs, and see how it performs, because it would be really interesting to see the outcome of that.
Yeah, so Tim McMasters was onto something, mate. It's a very good technique.
All right, mate. That's it for today, I guess. So thanks everyone for watching, and catch you again.
Thanks very much, Fred. See you, everyone. Bye.